Good evening, students. Welcome to the session. I hope you have revised the class on Saturday and Sunday. Okay, so today we have the last class on PGBP. We'll try to finish it off in today's class, the entire PGBP provision. But I expect you to constantly solve the questions. I do remember there were some questions on the questions in the module, but I would be able to take it up at the end of the class if time permits, or maybe tomorrow or day after tomorrow before we, venture into the capital gains. Okay, so I'll quickly just start with it because we have lot to finish. So as we have done till 40 and 40A, which was on the disallowances, isn't it? Now we are moving towards section 43B. What is the section 43B? Section 43B is on the deduction on the payment basis. Deductions to apply on the payment basis, right? So what does section 43B says? Let's look at the screen. It says, notwithstanding anything contained in any other provisions of this act. Meaning, this particular section, if you remember, section 28(1). If you remember section 28(1), what we had studied that point in time, and I told you this exception also, that profits and gains of the assessee during the previous year, right? So at that point in time, we had linked this particular thing, if you remember, or don't you? So if you see this, move on to residential status, then classification, yes. During the previous year, profits and gains from business or profession carried on by the associate anytime during the previous year. So I had told you that time that there are exceptions to this particular rule, that during the previous year, prior period cannot be claimed, future expenses cannot be claimed, and also the exception to it, this is section 43B, where the deductions are not claimed in the year of incurrence, but in the year when the payment is made. So 43B is the exception, isn't it? We had done this already, right? So now if you see section 43B, what does it say? Section 43B is saying, notwithstanding anything contained in any other provision of this act, meaning it overrides section 28. A deduction otherwise allowable under this act in respect of any sum payable by the assessee by way of tax, duty, cess, fee, right? Sum payable by the assessee as an employer by way of contribution to any provident fund or superannuation fund or gratuity fund. So remember in 36(1)(4)(a), there I was telling you that employer's contribution to provident fund is subjected to section 43B. As in, you can contribute any time before the due date of filing return of income, and you'll be allowed deduction. But employee's contribution to the provident fund will be allowed as a deduction only when it is deposited before the due date of the fund, right? So employee contribution is not subjected to 43B, and there is a specific amendment to that effect. Clear? So tax, duty, cess or fee, employer contribution, 36(1)(2), which is bonus or commission. So this is also what we saw that day, that bonus or commission deduction, which is not in the nature of the profits or dividend, which is for the services earned, is allowed as a deduction. but it is subject to 43B. Sum payable by the assessee as interest on any loan or borrowing from the public financial institution or state financial corporation or state industrial development corporation. Interest on any loan or borrowing from a deposit taking NBFC or systematically important non-deposit taking NBFC. Sum payable by the assessee as interest on any loan or advances from a scheduled bank or a cooperative bank other than primary agricultural credit society or a primary cooperative agricultural and rural development bank. Sum payable by the assessee as an employer in lieu of any leave at the credit of his employee, right? Then any sum payable by the assessee to the Indian Railway for use of railway assets shall be allowed irrespective of the previous year in which the liability to pay such sum was incurred by the assessee, according to the method of accounting regularly employed by him, only in computing income referred to in section 28 of that previous year in which such sum is actually paid by him. So as I said, this is an exception to your section 28. Are we clear? Are we clear? Then there are certain explanations which are introduced in respect of this particular section, which is what we are going to learn. But as I said, that any particular expenditure which is covered under 43B will be allowed on payment basis irrespective of the previous year in which the liability has been incurred. Are we clear? So this sum, if it is paid on or before the due date of furnishing the return of income under 139(1), then the sum will be allowed as the deduction. Clear? So the sum should have been paid before the due date of filing of the return of income under 139(1). So as you can see here, before furnishing the return of income under 139(1). Clear? Are we clear? Any questions? Also, where in respect of any sum, which is in the nature of the interest, on the borrowing, deduction is allowed in computing the income referred to in section 28 on the due basis. On the due basis, then the assessee would not be entitled to any deduction in respect of such sum when it is actually paid by the assessee. So let's say, for example, if the deduction has been already allowed on the incurring basis, on the accrual basis, then the assessee will further not be allowed the deduction on the payment basis. Let's say if it has already claimed it, then again it will not be allowed as the deduction. Clear? Any questions so far? Any doubts? Any question? Clear? Then there is the explanation in this regard. There is an explanation in this regard. What does it say? It says that where a deduction of any sum in respect of interest payable is required in accordance with this section 43B. So section 43B requires you to allow the interest deduction only when the interest has been actually paid. However, it happens sometimes that the interest may not have been paid. Then in that particular case, the interest which is there is converted into a loan or a borrowing. Right? So interest which is referred here, if it remains unpaid and it gets converted into another loan or borrowing, then explanation 3C provides that in such a case, the deduction will not be allowed because the interest is not actually paid. So if you read over here, what does it say? For the removal of the doubts, it is hereby declared that a deduction of any sum being interest payable under clause D, which is interest on borrowing of the public financial institution, as well as there is explanation 3CA, which is in respect of the interest on loan or borrowing from NBFC, right? So both of these, or in respect of even this particular interest, which is from the scheduled bank, so interest payable shall be allowed. So it is D. There are 3C, 3D, 3A, 3 explanations. So DA is included in 3D, 3CA, and the this particular scheduled bank is in the explanation 3D. So D, DA, and E, all of this shall be allowed if such interest has been actually paid. And any interest which has been converted into a loan or borrowing or a debenture. So this is a latest amendment because if you see, this is in italics. Or any other instrument by which liability to pay is deferred to a future date shall not be deemed to have been actually paid. So what does it mean that conversion of interest is not equal to the actual payment? So deduction is allowed only on actual payment, right? So deduction will be allowed only when the converted interest is actually paid, right? There is a CBDT circular to that effect also. CBDT circular number 7/2006. So earlier the term debenture was not present here, and now while Finance Act 2022 amendment, even that has been introduced over here. Are we clear? Because there was a decision of a High Court wherein the High Court interpreted this particular explanation 3C in a way to say that here, if the interest is converted into a debenture, then the explanation 3C will not get attracted because the word debenture is not used here. So only when it is converted into a loan or borrowing, only then it will deem not to have been paid. But if it is converted into debenture, it will be allowed under 43B. So therefore, to override that particular judgment or ruling, here the term debenture also has been introduced. Are we clear? Okay. So section 43B requires you to have the deduction on the payment basis. Clear? Are we clear? Okay. Now, in respect of, let's say, sales tax liability. In respect of the sales tax liability, there is a CBDT circular with regard to that. Because the provision says that it will be allowed, the tax, duty, cess, fee is allowed only on payment basis. So the principal portion which is there, and the interest portion which is there. Interest portion on even sales tax liability will be on payment basis under section 43B. Right? Under section 43B. Then in respect of the principal portion. If the sales tax law, let's say, provide, or the GST law, let's say, provide that deferred GST is to be treated as actually paid. So if there is a deferred sales tax or the GST, right? So then in that case, in such a case, unpaid sales tax is deemed as actually paid and disbursed as loan by the state government. Then deduction will be allowed in the year in which the conversion is permitted. So if this is the old CBDT circular, if the sales tax law, this was in the context of the sales tax law of state, provide that deferred sales tax is to be treated as actually paid, it would be treated as paid under section 43B. Are we clear? Because the law provides in that particular manner. What if it's an advance taxes which are paid? Let's say advance GST. Whether allowed under section 43B? So section 43B, which is there, is a provision of the disallowance, and it doesn't enable the taxpayer to claim something what is not allowed, right? It is not a provision which is, allowing something. So if the advance GST is paid, that is not allowed unless and until the expenditure is incurred. So advance GST pay, not allowed only in year when adjusted against actual liability. Clear? Okay. So advance GST paid will also not be allowed as the deduction, right? So here we have covered all the allowances and disallowances under 36, under 40, 48 and 37, 43B. Clear? So all the allowances and disallowances are covered over here. Now, after 40A, we would move towards the other provisions, which is in respect of the presumptive taxation. But any doubt till now? Any question? Okay. Also, as I said in the 43B, there is a specific explanation. Maybe you can, put it that as well for your record, which is a recently introduced explanation for the employee's contribution to the PF. Explanation 5. It is hereby clarified that the provisions will not apply and shall deem never to have been applied to a sum received by the assessee from any of the employees to which provision of 224(10), which is the employee's contribution. As I said, it is treated as your income first. So explanation 5 clarifies that the provision of 43B does not apply. It would have never deemed to have been applied to employees' contribution received by the employer towards any welfare fund. So 43B cover only the employer's contribution to the PF fund and does not include the employee's contribution to the PF, which is credited to the employee's account in the relevant fund. That has to be before the due date of the fund. Are we clear? Okay. Then let's proceed further. Shall we proceed further? Okay. Now, as I said, we are moving towards the section 44 onwards. So, this is your maintenance of accounts and tax audit. And then the presumptive section. Are we clear? Okay. So let's move towards section 44A first. Section 44A. Sorry. Section 44 AA. Maintain the books of accounts and other documents notified by the notified profession and by the other business or profession. Okay. So 44A, we have two parts. For the specified profession and then for the other businesses. For the specified profession and then for the other businesses. So, first for the specified profession. For the specified profession, what are the specified profession? So, specified profession here are the authorized representative, the profession of film artist, actor, cameraman, director, music director, art director, dance director, profession of company secretary, information technology professions, legal, medical, engineering or architectural profession or accountancy or technical consultancy. So 44 AA covers all these professions. Are we clear? So these are the specified profession under 44 AA. Clear? There are certain professions which are in the provision itself, and then there are certain professions which are defined, which are notified by way of a gazette. So these are your specified professions. And then you can write it over here. Plus directors, CS, company secretary, then film artist, IT professionals. IT professionals. What is the criteria for them? Gross receipts, if it exceeds in all the 3 previous years, more than rupees 1,50,000, exceeding rupees 1.5 lakh. In case of newly set up, then in that particular case, gross receipts exceeding 1,50,000 in that particular year. In that year. Are we clear? If it is exceeding, then books of accounts to be maintained as per rule 6F. As per rule 6F. Here, these are the prescribed books of accounts and documents to be maintained. And what are the prescribed documents under 6F? Cash book, journal, ledger, bills, right? Vouchers. In case of a medical profession, daily case register, inventory book, all these are to be maintained, right? And for how many years it has to be maintained? Period 6 years. Period 6 years. For 6 years, it can be maintained. But as the reassessment can happen for 8 years, so indirectly you're required to maintain for 8 particular years. Are we clear? So books of accounts for the specified profession. Are we clear? Are we clear? Then next is non-specified business or profession. We can write it over here. Others. Other than notified professionals. Then here also, in case of individual or HUF. In the case of individual or HUF, then in that particular case, again, existing business or profession, then in that case, in case where the income from the existing business or profession exceed 2,50,000 PGBP, exceed rupees 2.5 lakh, or the turnover exceed 25 lakh in any of the 3 years immediately preceding the accounting year. 3 preceding previous years. Clear? In case of the new business or profession, then in that case, these conditions only, but in that year. In that year. Are we clear? In case of other than individual or HUF, again, in case of the existing business, income greater than 1.2 lakh, so PGBP greater than rupees 1.2 lakh, or turnover greater than rupees 10 lakh in any of 3 preceding previous years. And again, in case of new, the same conditions, but in that year. Then in that case, you are required to maintain the books of accounts, right? Then then another category which is required to maintain the books of accounts is deemed one, where the income is lower as compared to the income computed at a presumptive basis. So let me write it like this. If income lower than presumptive profits under section 44A or 44BB or 44BBB. Clear? Then in that case, you have to maintain compulsory the books of accounts. Or where section 44AD4 is applicable. That is where assessee has not declared profits in accordance with section 44 AD 1 in any of 5 assessment years, plus income exceeds basic exemption limit. Here there is no condition of income exceeding basic exemption limit in the presumptive profits under 44 AE or BB. But in case of 44 AD, if your income exceeds the basic exemption limit, then only you will have to maintain the books of accounts if you have not offered as per 44 AD. For 44 ADA, you have to maintain books of accounts because 44 ADA is applicable only to the specified profession. Are we clear? Clear? So this is your section 44A. 44A. Now, without wasting more time here, because these are very small sections, then moving towards the 44AB, which is the tax audit. Section 44AB, tax audit report. Clear? Now, for the 44AB, again, for the business, what are the limits? If the cash receipts and the cash payments, are greater than 5% of the total receipts or payments, then the condition is if the total sales or total turnover or gross receipts or sales greater than rupees 1 CR. Greater than rupees 1 CR, right? So if the total sales turnover or gross receipts exceed 1 CR in the relevant previous year, in case where the aggregate cash receipts are lesser than, this should be lesser than and not more than. Cash receipts and cash payments greater than, I'm so sorry, this was correct. Greater than 5% of the total receipts or the total payments. Are we clear? Then it is 1 CR. Clear? Then, in case the cash receipts and cash payments are less than equal to 5% of total receipts or payments, then total turnover or gross receipts or sales greater than rupees 10 crores. Are we clear? Then in case of the profession, gross receipts greater than rupees 50 lakh or lower profits under section 44 ADA. Clear? In the case of business, again, if you have lower profits under section 44 AE, or you have lower profits under section 44 AD, or if you do not fulfill the condition of 44 AD. For 44 AD, we can write like this. Instead of lower profits, let's write if 44 AD 4 is applicable. That is, if you have not offered as per 44AD in any of the 5 previous years, plus the total income exceeds the basic exemption limit. Are we clear? Here also you should write lower profits under 44ADA plus total income exceeds the basic exemption limit. Clear? Then in that case, you have to furnish the audit report. Also for 44AD, the total turnover limit is greater than rupees 2 crores. For other businesses, it is 1 CR. Then you have to furnish the audit report in form 3CB, 3CD, right? In form 3CB and 3CD. And in case audit is required under any other law, then form 3CA and 3CD. Clear? Also now the audit report has to be furnished before 1 month prior to the due date for furnishing. 1 month prior to the due date for furnishing return of income under section 139(1). That is, by when it has to be furnished? 30th September. So the due date for filing the return of income for other than companies is 31st October. Hence, the specified due date for tax audit will be 30th September. Are we clear? So the due date of audit will be 30th September. Clear? Then, if you have not furnished the audit report, the penalty would be penalty for not furnishing the audit report. Then in that case, it is lesser of 0.5% of total sales or turnover or gross receipts or rupees 1.5 lakh. Also now the audit report can be revised. The audit report can be revised. Revision of audit report is possible if, only in this case, if there is payment, after furnishing of report which requires disallowance, which requires the recalculation of disallowance, which requires recalculation of disallowance under section 40 or 43B. And this revision can be done before the end of the relevant assessment year. So why this particular provision has now been introduced? Because see, earlier the due date of the audit report and the due date of filing the return of income was one and the same, right? Now the audit report has to be filed prior. Now what if I have disallowed certain expenditure because it was not paid? Let's say interest was not paid till the date of filing audit report. How would I know that it would be paid before the due date of return of income? But let's say until the September, the interest was not paid, and interest was only paid in the month of October. Then I will have to recalculate the disallowance so that I can allow it, and I can then revise the audit report. Similarly, if the same, let's say TDS was not deducted till September and not paid. Now in October, I have deducted and paid the TDS. So then ideally the disallowance should not have been there in audit report, and therefore I should be allowed the deduction, and therefore we can make the revision. Are we clear? Okay. Aniket, employee paid next year, then also he would be allowed to deduct. No. Employee's contribution to the PF only, it has to be within the due date of the fund, not later on. If it is later on, then it will be considered as the income and will not be allowed as deduction. Clear, Aniket? Okay. Fine. Now the last part, the presumptive taxation. Presumptive taxation. So first, section 44 AD. With section 44 AD, it is allowed to individual or HUF or partnership firm other than LLP. Right? These are the eligible. Who is non-eligible? Commission agents or brokers, agents, notified professionals under 44A. So professionals notified under section 44A, 44AA. What is the criteria? Turnover less than equal to rupees 2 crores. Presumptive income is 8% of turnover, 6% of turnover, 6% of turnover in case where, what is it? What is it? 6% is when, you know it, when the amounts are received in the electronic mode, right? When the amounts are received in the electronic mode, then in that case, it is 6% in respect of the turnover. If I will write it as amounts received and in digital or non-cash mode, right? So if it is received through account paid check or bank draft or ECS or credit card, debit card, IMPS, NEFT, amount received during the previous year or before due date of filing return of income under section 139(1). So you have to consider that the amount even received before the due date of filing return of income, that will also be considered. Clear? Then no further deduction is allowed over here. No further deduction is allowed, including remuneration or interest to partners, even that is not allowed as the deduction. Are we clear? Maintenance of books of accounts and audit. We have already done that. Section 44 AD4, if applicable. Now, what is section 44 AD4? So let's say I have opted for 44 AD in AY 23-24. Then for the next 5 years, which is AY 24-25 to 24-25, 25-26, 26-27, 27-28, 28-29, 29-30. I have to be governed by 44 AD. In case in one of the year, let's say in AY 25-26, I'm not offering 8%. Then I will have to maintain books of accounts plus the tax audit report, provided income greater than the basic exemption limit. Are we clear? Further, even these assessees have to pay advance tax, but before 15th of March. The other installments are not applicable for them. Clear? So this is your presumptive taxation under 44 AD. Moving further, under 44 AD A. Under 44 AD A. In case of 44 ADA, this is applicable for the notified professionals. So, 44 ADA, notified professionals as per section 44 AA. Are we clear? Only resident individual HUF partnership firm other than LLP. Clear? What is the eligible business? Eligible businesses, gross receipts less than rupees 50 lakh. What will be your presumptive income? 50% of the gross receipts. Maintenance of books of account plus tax audit report if lower profits under section 44 ADA plus income exceeds basic exemption limit. Again, advance tax by 15th of March. I'm not investing much time over here because these are small provisions and you have already done that as well, right? Next is 44 A. This is in respect of applying, hiring, leasing goods carriage. Applying, hiring and leasing goods carriage not more than 10 carriages at any time during the previous year. Less than 10 carriages at any time during previous year. Even if, let's say, for example, he has 12 carriages during the year and then he has sold it off 2, but it should be 10 anytime. If it increases beyond 10 at any time during the previous year, 44 AE will not be applicable. So, less than equal to 10 carriages at any time during the previous year. The presumptive income will be there are two categories, heavy goods vehicle and light good vehicle. Heavy good and light good vehicle. So what are the two categories? For the light good vehicle, it will be rupees 7,500 per month or part of the month. per month or the part of the month. And what is a heavy good vehicle? Heavy good vehicle means where the gross weight is greater than 12,000 kgs. Gross weight of the vehicle greater than 12,000 kgs. 12,000 kgs. In that case, what is the presumptive income? 1,000 per ton. 1,000 per ton of gross vehicle weight. For every month or part of the month. Are we clear? So what is the gross vehicle weight? It is the total weight of the vehicle and which is certified and registered by the registering authority as permissible for that particular vehicle. Are we clear? Here, deduction, interest and remuneration to partners is allowable. So in 44 AD and 44 ADA, it was not allowable, but here it is allowable. Clear? Then books of accounts plus tax audit report, lower profits under section 44 AE. Here there is no condition of the basic exemption limit. Are we clear? Here there is no condition of the income exceeding the basic exemption limit. And advance tax here has to be in the 4 installments and not 1 installment. So advance tax for 44 AE is in 4 installments. Are we done? The other provisions of the presumptive taxation we will be covering in the non-resident taxation. So we are not covering over here. Clear? Now moving further, we'll finish few balance other sections and then we will move towards the specified deduction. So I'm just covering few small provisions now, what are left, and then we will finally be moving towards the specified deduction, which is where we are going to spend the major chunk of our time now. So as you have seen, we had covered the section 28, 30, 32 and 36, 40, 48, 43B, and now we have covered the 44AA, 44AB and the presumptive sections. Right? ICDS also at various points we have covered the ICDS as well. Clear? We have also covered most of the case laws from your module as well. Are we clear? Right? Few ICDS we will be covering that as well, but major part which was to be linkable I have covered. The other portion I can cover it in the next class also. Are we clear? Okay. Now what is remaining is speculation business. Speculation business. Now, explanation 2 to section 28 specifically provides that where an assessee carries on a speculative business, that must be deemed as distinct and separate from any other business. So speculative business is deemed to be distinct and separate business. Why? Because under section 73, the losses in the speculation business cannot be set off against the profits of any other business. It has to be set off only against the profit and gains of any speculative business. So, losses from speculative business can be set off against income from speculative business. Section 73. Now, what do we mean by the speculative business? So, speculative business is defined. Under section 43, we have the definition of the speculative business, right? What is the meaning of the speculative transaction? So, speculative transaction, I'll just put it over here. Let me just put it over here. 43. As I said, section 43 is the definition section, right? So 43.5 defines the speculative transaction. And what does it define? You can see in the screen. This is your section 43.5. Speculative transaction means a transaction in which a contract for the purchase or sale of any commodity, including stock and shares, is periodically or ultimately settled otherwise than by the actual delivery. So where I have not taken the delivery, that is considered as a speculative transaction. So what is not considered as a speculative transaction? It is defined here. A contract in respect of raw materials or merchandise entered into by a person in the course of his manufacturing or merchanting business to guard against loss through future price fluctuation in respect of his contracts for actual delivery of goods manufactured, which is the hedging. So hedging contracts are not covered. This is hedging contracts, which is to protect the price fluctuations, right? A contract in respect of shares and stocks entered into by dealer or investor to guard against loss in holding of stocks and shares through the price fluctuation. So hedging contract again in respect of stock. So this is also hedging in respect of stocks. It is hedging contract in respect of raw material. Contract entered into by a member of forward market or stock exchange in the course of any transaction in the nature of jobbing or arbitrage to guard against loss which may arise in the ordinary course of business. So a forward contract is not the hedging. Is not the speculative transaction. So forward contract. Eligible transaction carried out in respect of trading in derivatives. So even that is not considered as the speculative. Trading in commodity derivatives. All of this shall not be deemed to be a speculative transaction. So these are your exclusions. These are your exclusion. Are we clear? So this is not considered as the speculative transaction. Clear? Also, if you read section 73, which is in the case of the loss from the speculation businesses, Then the explanation to that section provides that, what does it say? I'm putting here. So explanation to section 73. It says that where any part of the business of a company, this is for the company, right? And not for any other assessee. Other than a company whose gross total income consists mainly of income which is chargeable under the head interest on securities, income from house property, capital gains, and income from other sources, or a company the principal business of which is business in trading of shares or banking or granting of loan and advances, consist in the purchase and sale of shares of the other company, such company shall be deemed to be carrying on the speculation business to the extent to which the business consists of the purchase and sale of security. Meaning what? Here you can write it down. So a company, in the exclusion, you can write down a company, the principal business, whose gross total income, whose GTI consists of mainly, as in majority of the income, sorry, Okay. Sorry, students, there was some technical glitch. We were on the speculation business. Yes, Aniket, intraday is a speculation business. So we were talking about here a company whose gross total income consists mainly of the income which is under the head under the head income from other sources, capital gains, and the income interest on securities. And four, we have covered over there as well. Correct? Then amount withdrawn from special reserve, all of that we have covered, but still one category is left. So that's what we are going to cover now. Section 41, deemed income. So remission or cessation of trading liability. Section 41(1). So if any allowance or deduction has been made, right? What is the condition for this? If any deduction or allowance has been made in any assessment here in respect of any loss or expense or trading liability Subsequently, if benefit is obtained, in cash or in any other manner, in respect of cessation or remission of such trading liability, if the benefit is obtained by way of remission or cessation of the trading liability, then the benefit or value of benefit deemed as income of the previous year in which the benefit is obtained. Right? The only condition is that the expenditure should have been claimed as deduction. This is also applicable in a case where the business has been succeeded by another person. In that case, the successor will be liable to tax in respect of any benefit received by him during the subsequent previous year. So, like the deduction for the bad debts is also available to the successor. We saw that, right? In case of the recovery of the bad debts also, it can be taxed in the hands of successor. C.K. Veerbhadra Rao, right? Deduction is also allowed to the successor if the amount is taken into consideration in the income of the predecessor. Similarly, here also remission or cessation of trading liability is allowed as is deemed as the income in the hands of the successor. Income deemed in hands of successor if deduction of expense or liability allowed to the predecessor. Right? So in case there is amalgamation or where a firm is succeeded by another firm, in case of demerger, then this will be taxed in the hands of the other person also. Are we clear? So we have finished section 41 as well. Clear? Are we clear? Any doubt till now? last one section which I wanted to take it up. So there is section 43CA, which we will cover with section 50C under the capital gain, which I am not covering over here. There is one more section 43D, which section 43D. This is special provision of income of public financial institution or public companies. What is this section? In case of a public financial institution or scheduled bank, cooperative bank, state financial corporation, state industrial investment corporation, deposit taking non-banking financial company, or systematically important non-deposit taking NBFC, the income. So here you can write it: public financial institution, banks, or NBFCs, right? So income by way of interest, income by way of interest on assets recognized, or write it over here, interest on loans and advances recognized as bad and doubtful debts shall be chargeable to tax in previous year in which interest is credited to P&L account or actually received, whichever is earlier. So in case of the banks or financial institution, usually the interest on the loan would instead of this provision, or would in absence of this provision, be recognized on accrual basis, right? So in order to provide relief to the banks, NBFC or PFI, where the loans and advances could be recognized as bad and doubtful debts, so until it is credited to the P&L account or it is actually received, it will not be recognized as income for these kind of institutions. Otherwise, this may cause hardship to these institutions. Clear? What are the special provisions for PFI, banks or NBFC? One is section 43D. Second was 36(1)(7)(a). If you remember, it was provision for doubtful debt. And third was 36(1)(8), special reserve deduction. So these are only applicable for the banks or NBFCs or financial institution. Clear? Namita, speculation business. Speculation in business is where we do not take delivery. It is intraday kind of transaction. What it does not include is futures and options, the commodity transaction, derivative transactions, forward contracts, right? One second. Here, futures and options, we should write here in derivative contracts. FNO, right? Or a companies whose GTI consists of mainly income chargeable under the head company, IFHP, CG, IFOS, interest on security, or a company which has the principal business of trading in shares. So meaning intraday is the speculation. Hedging is not speculation, right? A company which has the business of purchase and sale of shares of other company is a speculation business. Clear, Namita? Any other doubt? Okay. Now, what I suggest is let's take a break of 10 minutes. We'll meet at 7:30 and then we are going to start with the new topic altogether, which is the specified deductions. So let's take a short break of 10 minutes. Okay. Namita, terminal depreciation is going to be taxed under section 50. Sorry, over and above the terminal depreciation is going to be taxed under section 50, which is under the head capital gain. Now, your question is that 58. Your question is that whether in that case it will be the short-term capital gain or long-term capital gain. So for that, it will be the normal, it will be considered in a normal way only for the capital gain, which is on the sale of the depreciable asset, right? Which is on the sale of the depreciable asset, that is deemed to be the short-term capital gain. Are we clear? Which is under section 50. Which is considered as the short-term capital asset, short-term capital gain, whereas in the case of 50A, nothing so far has been provided, so it will be considered a normal way based on the period of holding. Clear, Namita? Okay, now very quickly, starting with the specified deductions. First is 33A. First is under section 33A, which is in respect of the tea, coffee, rubber development entities. So let's quickly begin with that. Specified deduction under section 33A. Sorry. The section 33AB. Deduction in relation to tea, coffee, and rubber development account. Section 33AB. Now, what does section 33AB say? So see, the growing and sale of the tea, coffee, tea and coffee is considered as the agricultural income. Right? That is considered as the agricultural income. But this is in relation to the growing and manufacturing tea or coffee or rubber in India. Right? So only if it is cultivation, then it is an exempt income. So out of which also, as per rule 7, 40% is taxable, 60% is considered as exempt, right? But this is in relation to growing and manufacturing tea or coffee or rubber in India, right? So in that particular case, we have section 33AB. Now, what does section 33AB provide? Let's quickly write it down over here. Let's quickly write it down. So, eligible assessee is growing assessee engaged in the business of growing and manufacturing tea or coffee or rubber. Right? Now, there they have the deduction. What is the quantum of the deduction? Lower of the amount deposited. So these kind of assessees have to deposit the amount in a special account. Amount deposited in the special account or deposit account. So they have to deposit with the National Bank the amount in a special account maintained by the assessee with that bank in accordance with the scheme approved by the tea, coffee or rubber board, right? Or they have to deposit at the amount as per the deposit account opened by the assessee in accordance with the policy of the central government. So amount deposited in the special account or 40% of the profits of the business. Before any deduction under this section. Before any deduction under this section and before setting off brought forward loss under section 72. So 40% of the profits of such business of deposit is 6 months. Time period of the deposit is 6 months from the end of the previous year or before the due date of filing return of income, whichever is earlier. So they have to deposit the amount before the due date of filing return of income or before the 6 months, end of the 6 months from the previous year. Clear? Are we clear? So this deduction shall not be allowed also unless the accounts of such business are audited by a chartered accountant before the due date of the tax audit report. That is before the 30th September. Are we clear? Now here, this particular deduction, how do we calculate here? So income, whatever income you will have, less deduction under section 33AB. Now here, whatever the business income will remain, right? As per rule 8, in case of tea, 40% will be taxable, 60% will be exempt. In case of rubber, as per rule 7A, 35% will be taxable, 65% will be exempt. In respect of coffee, grown and cured, 25% will be taxable, 75% will be exempt. In respect of coffee grown and cured and grounded, grown, cured and grounded, 40% and 60%. Are we clear? So 40% will be taxable, 60% will be exempt. Clear? Now, what if the amounts are withdrawn from the deposit account? So, amount withdrawn from the deposit account. There are conditions to it. So, any amount which is lying in the deposit account or in the special account cannot be withdrawn. Cannot be withdrawn except for the purposes specified in the scheme. So, the amounts cannot be withdrawn except for the purposes which are specified in the scheme, which is for the purpose of any particular asset which is to be used for this particular scheme. Only then it should be withdrawn for using that. It is allowed to be withdrawn only in the following cases. For the purpose of the scheme, permitted only if then death, closure, liquidation, partition and dissolution. Liquidation, partition and dissolution. Are we clear? So only in these circumstances it will be allowed to be withdrawn. Also, amount withdrawn on the closure of the business or on the dissolution of the firm. The whole of such withdrawal shall be deemed to be the profits and gains of the business of that particular year and shall be chargeable to tax as the income of that year. So, amount which is withdrawn on the liquidation or on the on the closure or the dissolution of the firm, in that particular case, it will be considered as the income of the on the closure or on the dissolution. In these two cases, income under PGBP, chargeable in year of withdrawal. Clear? So under section 33AB, in case the amount is permitted to be withdrawn, but the problem arises in the of if the amount is withdrawn in respect of the closure of the business or on the dissolution, then in that case, the amount will be taxable as the income. Clear? Are we clear? So, on the closure or even in the case of partition or liquidation, it will be considered as the income under the PGBP chargeable in the year of withdrawal. Are we clear? Now, for the purpose of the withdrawal, as I said, the withdrawal has to be for the purpose of the scheme, only for the purchase of specified assets, right? So withdrawal is permitted only if it is in accordance with the purpose of the scheme, which is to purchase the asset. So withdrawal, or you can write here as well, purchase of the assets. Or rather you can write purchase of specified assets. Now, what are the specified assets? So, if the amount is withdrawn, right, from the deposit account and is utilized for the purpose of the purchase of the asset, then it is all right. But what are the ineligible assets that we need to see? Ineligible assets. Plant and machinery installed in office premise or residential area. Second, office appliances other than computers. Plant and machinery whose whole cost is claimed as deduction. Plant and machinery installed in the industrial undertaking. Industrial undertaking for the manufacturing or production. Are we clear? Then, if the amount is withdrawn for these ineligible assets, then in that particular case, the whole of the amount so utilized will be treated as the taxable profit. The amount withdrawn shall be treated as taxable profits. Shall be treated as taxable profits and taxed accordingly of that year. Are we clear? Clear? Next is, if I have withdrawn the amount, and I have not utilized the amount, where any amount is withdrawn, but it is lying idle because it is not utilized in accordance with the scheme or deposit. So the unutilized amount shall be deemed to be the profits and gains chargeable to income tax as the income of the previous year. Are we clear? So, amount, let's make it like this. Amount withdrawn from deposit account number 1. Withdrawal for the purchase of the ineligible assets. Sorry, here you can make it as purchase of assets only. And third, amount withdrawn but lying unutilized income. It will be considered as income under the head PGBP. Except in case where the amount is released. Where the amount is released at the amount is released on the death of the assessee or partition of HUF or liquidation of company. So as you will see here, for the death, if the amount is withdrawn, we are not taxing it. We are only taxing it on the closure and the dissolution. We are taxing it on the closure and the dissolution, right? These two. Even on liquidation and partition, we are not taxing it. Correct? So therefore, in that case, this may create confusion. So you can put it like this. So death, liquidation and partition, if you are withdrawing, that will not be taxable. Only on closure and dissolution, it will be taxable. So if the amount is lying unutilized, it will not be taxable if it is on the death, partition or liquidation of the company. Are we clear? Then amount withdrawn utilized for the expenses utilized for the business expense. So see, we are already allowing the deduction under section 33AB. Now, if the amount is withdrawn, then in that case, if the amount is withdrawn for the business expense, then can I again claim the business expense as a deduction? Let's say, for example, if I have withdrawn the amount and I've used, let's say, for the purchase of raw material. Then in that case, or let's say I've withdrawn the amount and paid the salaries. So can I claim again the deduction of the salaries? The answer is no. Because we are already allowing you the amount withdrawn as the deduction under 33AB. So again, when you pay the salaries, that will result in double deduction. So this is not eligible for deduction. The expense is not eligible, not the amount withdrawn. The expense is not eligible for the deduction. Clear? Then if the assessee has sold or transferred the asset which is acquired in accordance with the scheme. So asset acquired is sold or transferred at any time before expiry of 8 years from the end of previous year in which acquired. Right? Then the portion of the cost or the deduction which is relating to that portion of the cost shall be deemed to be the PGBP of the previous year in which the asset is sold or transferred. So, cost allowed as deduction, PGBP in year of transfer. Or transfer is in consequence of the succession, or in case of succession of a firm. Are we clear? In that particular case, it will be exempt. Any doubt? Clear? Namita, in withdrawal of amount, conditions is not mentioned that the amount can be withdrawn for the purchase of the asset. Yes, it is not mentioned, but it is for the purpose of the scheme. And if you see, we are not allowing you the revenue expenditure. If you're paying for the revenue expense, then the amount withdrawn will not be allowed again as a deduction. So it is for the purpose of expense or for the purpose of even the assets, it can be there. But only in respect of the specified assets, the amount can be withdrawn. In case of, only in the case of the eligible assets, it can be withdrawn. In case of ineligible asset, it cannot be. So that is condition which I have just written to explain you. Interest earned on amount deposited, it can be considered as business income because this is in relation to the business and this is not to earn the interest. So it may not be taxable under income from other sources. See, we are not saying that the agricultural income, Namita, on the closure of the business will not be there. Agricultural income will still be there. It is only in respect of the agricultural income is 60%. Correct? So 40%, which is the deduction given to you, if the business is closed, then in that particular case, if we have allowed you the deduction, we'll take it back because we never intended, as a government, never intended to give the deduction if the business is not being carried out. Why this deduction is given, Namita? So as to encourage the businesses, right, in a particular sector. These are sectoral deductions These are specific sector-based deduction in order to give an impetus to these particular sectors. Now, the business itself is getting closed. What is the point of giving the impetus to such kind of business? Therefore, it is being taxable. Clear, Namita? Namita, in that IBM Global case, the employees are the assets for the company. You are correct. But here, it is for the enduring benefit for the business to carry on the business effectively. The trained employees were hired. So if you remember, we said that not all the enduring expenses are capital in nature. If the expenses are such that it enables the business to be run more effectively, if it saves my time, if it saves my cost, then it can be revenue expense. Clear, Namita? Namita, why depreciation will be allowed if the deduction has already been allowed? Then there will not be any depreciation under 33AB on the assets. Because once we are allowing the entire cost as deduction, then however, why the depreciation will come into picture? Sorry, Mithun. Mithun, if the sale is made in the second year, let's say I had claimed a deduction of 100 rupees, out of which the asset cost was 40. So now 40 will be taxable as the PGBP in the second year. Clear? Okay. Similarly, there is also a deduction, a similar deduction under section 33 ABA for the site restoration fund. Under 33 ABA for the site restoration fund. Now, this particular 33 ABA is for the business engaged in the prospecting, extraction, or production of LPG or natural gas, right? So, the quantum of deduction in this particular case is, it's very similar to 33 AB only. Deduction will be amount deposited or 20% of PGBP, whichever is lower. Amount deposited or 20% of PGBP. And the time limit for making the deposit is before the end of the previous year, right? Before the end of the previous year. Before end of the previous year. Are we clear? Here also it provides that for the purposes of the 20% of PGBP, the brought forward losses under section 72 will not be taken up. Are we clear? And even interest on deposit will be considered as deposit only in this particular case. Then the other provisions remain the same. You have to get the books of accounts audited. Then there are conditions to the withdrawn except for the purposes of the scheme. The withdrawal shall not be for the ineligible assets which are similar as machinery, plant in office or residential premises, office appliances, or for the industrial undertaking. Then withdrawal on the closure of the account will be taxable. If the withdrawal is for the the withdrawn amount is not utilized, that will be taxable. If the withdrawn amount is for the business expense, that will not be allowed as deduction. Then in case there is sale or transfer within the period of 8 years, that will again be taxable. So everything remains the same. Clear? So this is 33AB and 33ABA. Next section is section 35. Scientific research expense. So in case of scientific research expense, I'll take it up from your module only because it's 100% now. Earlier there used to be different rates, but now it is 100% only. So it is very simple provision. I'll just make a chart. You can also refer from your module. Deduction for scientific research. If it is for the own business, if it is pre-commencement, if it's a pre-commencement, then for the 3 years prior, if it's a capital expenditure, if it is a capital expenditure prior to the commencement of the business, then it is under 3521A. 3521A 100%. Other than the land. 100% 3521A. Clear? If it is a revenue expenditure, if it is the revenue expenditure, then in that case, 100% again expenditure allowed. 100% of the expenditure. This will include salary and purchase of material. Salary or purchase of material. 100% expenditure is allowed. This will be allowed in the year. So any revenue expenditure which is incurred by the SSC on scientific research, even the expenditure which is incurred within 3 years immediately preceding the commencement of the business on the salary of the research personnel which is engaged in scientific research, or on purchase of material inputs for such scientific research, will be allowed as a deduction in the year in which business is commenced. Deduction allowed in previous year in which business is commenced. This is under section 3511. Are we clear? And as I said, the capital expenditure which is prior to the commencement of the business except on land will also be allowed as the deduction in the previous year in which the business is commenced. So here you can write down deduction in the previous year in which the business is commenced. Clear? Are we clear? So the capital expenditure which is incurred, which cannot be claimed as deduction, can be carried forward to the succeeding years like the unabsorbed depreciation. So capital expenditure which cannot be absorbed can be carried forward to the future years and shall be treated as the allowance for that year, and it can be carried out indefinitely. It can be carried out indefinitely. So here you can write it. Sorry, this should come over here. 3511 is for the revenue expense. So here you can write down unabsorbed capital expense carry forward like unabsorbed depreciation indefinitely. Indefinitely. Clear? Are we clear? Fine. Then next is in respect of the post-commencement expenditure. post commencement expenditure. Again, we have capital, we have the revenue. The capital expenditure 100% will be allowed post the commencement of the business other than the cost of the land. Again, it should not be the cost of the land. Are we clear? So under section 35, the capital expenditure, either if it is a pre-commencement expenditure, that is also allowed for a period of 3 years. Even 3 years prior, the capital expenditure which is there, that is allowed as the deduction. And any revenue expenditure which is there, that is also 100% allowed as the deduction. So even revenue expenditure, 100%, which is for the scientific research related to the business. So it should be for the own business, right? And which is before the commencement of the business in respect of only salary and the material cost for the previous 3 years. Clear? And as I said, in respect of the capital expenditure, it will be allowed as the deduction as well. Capital expenditure will also be allowed as the deduction in the previous year in which the business is commenced, in respect of the pre-commencement, and in respect of the post-commencement also it will be allowed as the deduction. Clear? Any doubt till now? Any question, any doubt? Uh, 33 AB, okay, I'll take it up later, Namita, 33 AB again now. I'll take that up later. Okay. First, let me finish. If there's any doubt in respect to the scientific research expense, we'll discuss that first and then we'll take it up later. Okay. Okay. Then, in respect of the other business, paid to the others. Okay. Paid to the others. For that, we have the different provisions, right? Now, for that, when the expenditure is paid to the others for the research association, amount approved amount paid to the approved Indian company for scientific research. Indian company for scientific research. Again here, 100% is allowed under 35(1)(2)(a). 35(1)(2)(a). These section you should remember because this can come directly, with the section numbering. So you should remember. Then approved notified research association, university, college or other institution. University, institution or college. Then even this is allowed 100% for statistical research. For statistical research, this is allowed 100% under section 35(1)(2). Clear? The research may or may not be related to the assessee's business. Clear? Then, if the amount is paid, sorry, this is 35(1)(3). Then, amount paid to the university for scientific research. So, university for scientific research, Again, this will be 100% under section 35(1), 2. Clear? And the last one, is in respect of the sum paid to the National Laboratory. National Laboratory, this is also 100% under 35(2)AA. Then another one, company engaged in biotechnology, biotech or manufacturing. Again here, under 35(2)AB, 100% other than cost of land. Company which is engaged in the biotechnology or manufacturing, where then in that particular case, the 100% of the cost other than the cost of land and building. Land and building both. Clear? So this is what the scientific research expenditure is. Last one thing here, in respect of the capital asset. In respect of the capital asset which is purchased for the scientific research, if it is sold, then there is again the profit taxable under section 41. So under section 41, if an asset is sold, discarded, demolished or destroyed after being used for the purpose of the business, for the purpose of scientific research, then the taxability will be under section 41. So if asset purchased for scientific research is transferred or sold, then in that particular case, under section 41(3), if the proceeds of sale, if the sale proceeds are greater than the amount of deduction under section 35(1)(4), then the excess amount will be charged to tax as the income of the previous year in which the sale took place. So let's say, if for example, if the capital expenditure was, let's say, 3 lakhs, if the deduction, let's say, was 3 lakhs, right? Then if the asset is sold for rupees 4 lakhs, then the amount of deduction which is allowed, rupees 3 lakh, taxable in the under section 41 in the previous year in which asset is sold. Clear? So this is in relation to the capital expenditure, correct? And if the asset purchased for scientific research is, if the asset is purchased for the scientific research and it is now used for the other business, is used for other business, right? Where the asset is used for the purposes of the other business, then the actual cost of asset under section 43(1), if you remember we had done that, will be nil. And no depreciation would be allowed. No depreciation on that because you have already claimed that as a deduction. Clear? Are we clear? Any doubt? Clear? And if it is sold, then it will be taxable under 41. Yes, Namita. Now, your question is in 33AB, 40% deduction of all the earlier years are taxed on closure. Then government not given any deduction to 33AB business. So that's what, Namita, as I said, that if the business is closed, then there is no purpose of giving the deduction, right? It is possible that the taxpayers may claim the sham deduction and then close the business. So in order to avoid that, because this particular deduction is to give incentive to the businesses. So if the business is closed, then there is no incentive which is, required for that business. So that's why it will be taxable. Okay. So scientific research expenditure clear? Okay. One more very important amendment which is here in the scientific research expenditure. So these kind of research association, university, colleges or other institution, right? They have to take the approval because if you see, it has to be the approved association, university, college, right? So before the central government gives them the approval, they call for certain documents to verify whether these are the institutions which are genuinely carrying out the activities, right? So here, these research association, universities or colleges which have been deemed to be approved earlier, right, which have been approved earlier will have to obtain the fresh approval beginning with AY 22-23. So earlier, if they have been approved, after they have been approved, the central government issues the notification. So if any notification is issued in respect of these associations, university, college, or institution, these notifications will be withdrawn and these institutions will have to make an approval, will have to make a new approval, sorry, will have to request for the new approval. And only after that, these will be granted the new approvals. Are we clear? So these research association, university, college, or any other Indian company for scientific research has to prepare the statements and request for the approval. Also, these particular institutions are required to furnish to the donor a certificate specifying the amount of donation so that the donor can claim it. This is to verify the genuineness of such particular institutions. Are we clear? Next particular deduction is under section 35 ABA, which is in respect of expenditure for obtaining right to use spectrum for telecom license. So 35 ABA and then the deduction under section 35 ABB. This is under 35 ABA. Both are similar and 35 ABB is license to operate telecom services. This is under 35 ABB. Right? So in that respect, there is a deduction allowed under 35 ABB and 35 ABA. Clear? So 35 ABA is spectrum license, 35 ABB is telecom license. In respect of that, any capital expenditure incurred to obtain the right to operate. The right to operate telecom business allowed on actual payment basis. So the capital expenditure will be allowed on the actual payment basis, right? And how the deduction will be allowed? The deduction will be allowed over specified previous year. Deduction allowed over specified previous year. So how will you give the expenditure? This is on the pro rata basis. How will you give the deduction of the expenditure? So number of previous year if the license fees is paid, if the license fees is paid before the commencement of business. Before the commencement of business, then previous year in which business is commenced, expenditure will be taken from previous year in which business is commenced up to previous year in which license is expiring. So number of years will be from previous year in which business is commenced up to previous year in which license is expiring. In the other case, where license is obtained after the commencement of the business, in that year, previous year in which license is paid, license fee is paid up to the previous year in which license expired. Clear? Let's say if the license is transferred. License is transferred. Then in that case, if the sale proceeds are greater than the unamortized amount, sale proceeds are greater than the unamortized amount, and if the whole or part of the license is transferred. If the sale proceeds are greater than the unamortized amount, and if the whole or part of the license is transferred, then deduction under section 35 ABB nil. Deduction under 35 ABB will be nil. However, there will be deemed profits. There will be deemed profits in the year of transfer, which will be lower of sale proceeds minus the unamortized amount, meaning what you have earlier allowed as the deduction minus the sale proceeds. So the balance or the unamortized amount minus the sale proceeds. Deduction allowed till date. So the similar way we have the terminal depreciation we did for scientific research. In the same way, if the license is transferred, And if the sale proceeds are greater than unamortized amount, then there will be deemed profits in the year of transfer, which will be lower of the sale proceeds minus unamortized amount and deduction allowed till date. Clear? If the sale proceeds are lesser than unamortized amount, then if the whole license is transferred, then deduction under section 35 ABB will be unamortized amount minus sales consideration. If the part license is transferred, then remaining WDV deductible over period of license. Like in a similar way, we deduct the assets from the block. In a similar way, if the part of the license is transferred, then in that particular way, you will deduct the expenditure. So just let me give you a quick example for this so that you are able to understand it in a better way. Right? So just write down the example over here. Let's say telecom license of rupees 50 lakhs. Right? The period is for the 10 years. Sorry. Period is for the 10 years. Now let's say it is transferred first 32 lakhs. First case, if it is transferred for 32 lakhs, then consider, let's say if the whole license is transferred. So in the first case, the deduction under 35 ABB will be 50 lakhs divided by 10 years, which is rupees 5 lakh, right? Which is rupees 5 lakh. Now this transfer has been made after 2 years, right? The transfer has been made in the third year. Transfer made in third year, right? So what will be the unamortized amount? Your unamortized amount will be 50 lakh minus 5 into 2 years, 5 lakh into 2 years, which makes it to 40 lakhs. So if the whole of the license is transferred, then in this case, my unamortized amount is greater than the sale proceeds. So here my sale proceeds, which is how much? Okay, I have not given you the sale proceeds. Oh, sorry, 32 lakh is the sale proceeds. So 32 lakh is lesser than the 40 lakhs. And the whole of the license is transferred. Then in that case, the unamortized amount minus the sale consideration will be allowed as deduction. So deduction under section 35 ABB will be 40 minus 32 equal to 8 lakhs. 40 minus 32 equal to 8 lakhs. Are we clear? Clear? Let's say if the sale consideration was 43 lakhs. If the sale consideration would have been 43 lakhs, then in that case, if the whole license is transferred, then in scenario B, this is scenario A, in scenario B, 43 lakhs would have been greater than 40 lakhs, right? 43 lakhs would have been greater than 40 lakhs. Then in that particular case, deduction under section 35 ABB would have been nil, right? Deemed profits would have been lower of what? Deemed profits was lower of the 43 lakh minus the unamortized amount, which is 40 lakh, which is 3 lakh, or deduction allowed till date. So deemed profits will be 43 minus 40 lakh, which is 3 lakh, or deduction allowed till date, which is 10 lakh, whichever is lower, which comes to 3 lakh. That will be deemed profit. And then there will be capital gain. There will be capital gain, which is going to be short-term capital gain. If it is sold, if it is transferred before the 3 years, then it will be capital gain is nil. Capital gain here is nil. Why? Because 43 minus 40 is 3 lakh. We are considered here in the deemed profits only. Correct? Let's say if my consideration would have been, sale consideration, let's say, would have been 52 lakhs. Then in scenario C, 52 lakh greater than 40 lakh. Deduction under section 35 ABB nil. Deemed profits would have been 52 minus 40, which is 12 lakh or 10 lakh, whichever is lower, which would come to 10 lakh. And therefore capital gain would have been what? What would have been the capital gain? 2 lakh, which is 52 lakh minus 50 lakh, which is 2 lakhs. Clear? What if the part license was transferred? Scenario 1, scenario 2, and scenario 3. If the part license was transferred in scenario 1, where the sale consideration is lesser than the unamortized amount, then in that case, the balance amount would have been allowed as the deduction over the balance period. So 40 lakh is the balance amount, out of which the sale consideration 32 lakh, divided by how many years now? 8 years. So 1 lakh would have been allowed as the deduction. Clear? And in the other two cases, if the part license was transferred, the amount would have remained the same. The effect would have remained the same. Clear? Mithun, what about the unabsorbed capital expenditure verification from AY 2020? Should that also be re-verified? I didn't understand your question. Is this particular clear? Similar is the case with the spectrum license, which is under 35 ABA. So we have done for the telecom license. For the spectrum license also, it is the same. Because what was happening is there was uncertainty in tax treatment of payment in respect of spectrum. That is whether the spectrum is an intangible assets and whether there is depreciation or whether it is in the nature of license. So therefore, we have 35 ABA and AB. B. Again, in the spectrum, it is the same thing. It is allowed in the year in which the payment has actually been made, and the provisions remain the same totally. Are we clear? Any doubt? Any question? Any doubt? Okay. Then last one thing, in case the assessee fails to comply with the conditions of the 35 ABB, 35 ABA in respect of the spectrum license, then the deduction shall be deemed to have been wrongly allowed and the income tax return will be rectified by the assessing officer to disallow the deduction which is given to the assessee. This is specifically in the case of the spectrum license. Clear? Now, moving towards the next section, which is 35 AD. Which is for the investment linked deduction. Okay, there's a doubt here. Partial case is confusing. See, in the partial case, I will explain again for your purpose. So if the path license is transferred, let's look at this case. If the path license was transferred, then it is similar to how you reduce the sale consideration from the block of assets in the case of depreciation. So if the path license is transferred, your sale consideration is 32 lakh, right? Unamortized amount is this 40 lakh. So from this 40 lakh, you reduce the 32 lakh, which is your sale consideration, and you take the deduction on the pro rata basis in the balance period which is remaining. So which is 2 years. Out of 10 years, we have claimed it already for 2 years. So 10 minus 2, for 8 years, you will have to claim the balance deduction. Clear? There's one doubt regarding the scientific research expenditure, scientific research asset which is sold. So I can make a small chart for you for the scientific research asset which is transferred or sold. You can make it here. Okay, you can make it here. So sale of asset, you will understand by this chart more easily. Used for scientific research, right? If the asset is transferred to business, if the asset is transferred to business, WDV or the actual cost will be nil. If the asset is sold, if the asset transferred is sold, if the asset transferred to business is sold, then this is under 41. Clear? Where asset is transferred or sold directly, then lower of amount of sale proceeds or deduction allowed under section 35(1)(4) will be taxable under 41(3) and balance sale price, if it is greater than the deduction, then capital D. Clear? The excess amount will be taxable under capital D. Okay. Now we proceed towards the 35 AD. Investment linked deduction, section 35 AD. Clear? So in case of the specified businesses, there are several kind of businesses for which this particular deduction is given, which is investment linked deduction under 35 AD. What are the list of specified businesses? You can find it in your module. Setting up and operating cold chain facilities, warehousing facilities for the agricultural produce, laying and operating natural gas or petroleum pipeline for distribution, operating a hotel of 2-star or above category, building and operating a hospital with 100 beds, housing project, developing and building housing project for affordable schemes, production of the fertilizer, setting up and operating inland container depot or container freight station, beekeeping and production of honey, warehousing facility for storage of sugar, laying and operating a slurry pipeline, semiconductor water fabrication manufacturing plant, new infrastructure facility. So all of these with the objective of creating rural infrastructure and to give impetus to this business, the deduction is allowed under section 35 AD. Now, what is the deduction under this particular 35 AD? 100% of capital expenditure, which is wholly and exclusively for specified business. Wholly and exclusively for specified business, except goodwill, land, and financial instruments. Goodwill, land, and financial instruments, as well as assets purchased in cash greater than rupees 10,000. That is also not allowed as the deduction. Clear? So here the deduction which is allowed is 100% of capital expenditure which is incurred during the previous year wholly and exclusively for these businesses would be allowed as deduction. The revenue expenditure is any which way is allowed, but the capital expenditure will also be allowed. Plus expenditure prior to commencement of business. Expenditure prior to the commencement of the business allowed during the previous year in which assessee commences operation. Should be allowed during the previous year in which the assessee commences the operation. This particular expenditure prior to the commencement of the business should have been capitalized in the books of accounts. The expenditure should be capitalized in the books of accounts on the date of commencement of operations. On the date of commencement of operations. Are we clear? So even prior to the commencement of the business, the expenditure will be allowed. Clear? What are the conditions for this particular section? So it's a condition. All of these sections, if you see, are conditional deductions. So what are the conditions? Business not formed by splitting up or reconstruction of existing business. business not formed by splitting up or reconstruction of existing business. Second-hand machinery. It should not be set up by the transfer to the specified business of second-hand machinery. So it should not be set up, business not set up with second-hand machinery. The exception is if it is an imported machinery, then even if it's a second hand, it is allowed. Or if the second hand machinery, the cost of the second hand machinery is less than 20% of the total machinery. So the total value of the plant and machinery should not exceed the 20% of the plant which is used in the specified business. So the cost of the value of the second hand plant and machinery should not exceed 20% of the total value of the plant and machinery used in the specified business. So the condition is particularly that it should be a new business. That is why they are giving the deduction to them. It should not be formed by a second-hand machinery. Then it doesn't appear to be a new business. But if the second-hand machinery is less than 20% of the total machinery, that is fine. Clear? And if the deduction is allowed under this section, then the deduction cannot be claimed under 80IA, 80IB, all of that. Clear? Also, loss from specified business can be claimed against profits from specified business. It is not allowed against the normal business. Are we clear? This is under section 73A. It can be carried forward indefinitely. This is to give boost to the section. There is no time limit. But the only condition is it should have been claimed. It should be claimed before the due date of filing return of income under section 139(1). Are we clear? So the loss can only be claimed against the income of this particular business, but this should be claimed before the 139(1), and then it can be carried forward indefinitely. Are we clear? Any doubt? All right. Last one thing under the specified business. The transfer of the asset, right? If the asset is transferred, so the asset for the specified business has to be used for the period of the 8 years. Asset to be used for period of 8 years. Now, if the asset is transferred, if the asset is, first of all, discarded, demolished, or transferred, then if you remember, under section 28(7), Under section 28(7), sum received is taxable. Sum received is taxable. So if any asset on which the deduction is claimed under 35 AD is now demolished, destroyed, discarded, or transferred, then the sum received or receivable is chargeable to tax under 28(7). It's clear? Then, if it is not transferred but is used for any other business other than specified business, if used for any other business other than specified business. So asset has to be used for a period of 8 years. This is if it is transferred before 8 years or if it is used for any other business before the 8 years. Right? If it is used after 8 years or transferred after 8 years, then that is fine. Right? So in that particular case, deemed PGBP, there will be deemed profits and gains from business or profession under section 35(AD)(7)(a). And what does it provide? So it provides that any asset in respect of which a deduction is claimed shall be used for the specified purpose for business for a period of 8 years from the date when the asset is acquired. Now, if any asset is used for other than the specified business during the period of 8 years on which the deduction has been claimed, then in that case, it will be deemed to be the income of the assessee chargeable under the head PGBP. Clear? And what will be the income? The income will be the total deduction allowed under section 35 AD minus the notional depreciation on that asset, as if the deduction had not been allowed. So depreciation as if the deduction was not allowed. So notional depreciation on that asset. So amount of deduction claim minus notional depreciation, that will be considered as deemed income. And what will be the actual cost of asset? If it is transferred to other business, then what will be the actual cost of asset? It will be actual cost minus notional depreciation. Are we clear? Any doubt? Yes, Jacob, I will clear the doubts, whatever you have in any of the lecture. There's no problem. Jacob, loss of year should be claimed before the due date of filing of return, meaning that if you have any losses, you should have claimed those losses before filing the return of income. So let's say if I have loss in the year AY 22-23, then I should claim it before my return under which I will file by 31st October 23. Otherwise, the loss will not be allowed. Mithun, you are saying that part sale of license, then the calculation of 1 lakh deduction for the remaining 8 years is for the part of the remaining license, whereas the transferred part, the treatment will be as per the case 1, 2, 3. Am I right? No. So Mithun, if the license partly is transferred, then you cannot, break it. Like the asset, once it goes to block, can you identify the asset? that we have sold off this asset. You can identify, but as per the block concept, you cannot. So similarly, if the part of the license is transferred, if the unamortized amount is greater than your sale consideration, correct? So then in that case, if the part of the license is transferred, then you will just remove off the sale consideration from the unamortized amount, and the balance amount, balance WDV, you will amortize over the balance period of years. Clear, Mithun? Yes, if it's a belated return, then not allowed, Aniket. Okay, so I'll just cover a few small sections before we close off the lecture, because these are very, very small sections. We'll just finish it off and then we will, close the lecture for today. Are we clear? Okay. So see, one is in respect of 35 TCC and 35 CCA. 35 CCA is contribution for rural development. For that, the deduction is allowed. And then it is 35 CCC in respect of expenditure on the notified agricultural extension. So for those particular businesses, the sum equal to the expenditure incurred is allowed as the deduction. Then there is 35 CCD, which is in respect of expenditure incurred on notified skill development project. Again, whatever the expenditure is incurred, excluding the land and building cost, will be allowed as the deduction. Clear? Then, with respect to section 35D, 35DDA, which is 35D is preliminary expense, 35DD is amortization of expense for amalgamation or demerger, and DDA is amortization of expenditure incurred for VRS. So these three deductions are now remaining. Other than that, I have covered everything. Do you want me to cover it now, or should we cover it in the next class? What do you want? This will take around 10 minutes. But if you want me to cover now, I can cover it now, or else we can cover in the next class before we start the capital gains. Deemed PGBP 35AD. Okay, I'll take it up, Aniket, in the next class. It is also there in your module, but I'll take it up. Jacob, there is no such, pattern which is the most repeated in the exams. Quickly tell me whether you want me to extend the lecture and finish off PGBP, or do you want me to take it up in the next class? It will take around 10-15 minutes more. Okay, Aniket wants to extend by now. I'll take it up. Okay, let's take one section at least, 35D, which is amortization of preliminary expense. These are very small sections, but we can, finish it off very quickly. So amortization of the preliminary expense, which is there. This particular expense is allowed to the Indian companies. This is allowed to the Indian companies. Okay. So what is this expenditure? The 35D allows for the amortization of the preliminary expenditure incurred by the Indian companies. It is also allowed to the resident non-corporate taxpayers. For the establishment of the business or expansion of the business. Now, this is all these sections, if you see here, the prior period expense is also allowed in the scientific research under 35AD, under 35D. So these are exception to the prior period expenditure under 28, right? So this is applicable to Indian companies and resident non-corporate assessees. So in the case of new companies, expenses incurred before the commencement of the business, or in case of extension of the existing undertaking, to expenses incurred till the extension is completed. In the case of setting up of a new unit, expenses incurred till the unit commences production or operation. All these are the eligible expenses. Now, what is the amount eligible for the deduction? So, first of all, what is the eligible expenditures for the establishment of business or expansion of existing business or for commencement? Deduction will be equal to 1/5 of expense over 5 years. Over period of 5 years, right? And this will be allowed beginning with the previous year in which business commences or extension is completed or production commences. What are the eligible expenses? The eligible expenses are the expenditure in connection with the preparation of the feasibility report, preparation of project reports, conducting market survey, engineering services, legal charges for drafting any agreement. Where the assessee is a company, then legal charges for drafting the memorandum and article, printing the memorandum, fees for registering the company, connection with the issue for public subscription of the shares or debentures, underwriting commission, brokerage charges. So all of these expenditure which are there are the eligible expenditure. What is the limit of the expenditure? There's a limit. So what is the limit? In case of the company, 5% of the cost of project, 5% of the cost of project or 5% of capital employed whichever is higher. 5% of the cost of project or the 5% of capital employed, whichever is higher. And of that, 1/5 will be allowed for the period of 5 years. What is the cost of the project? So expenses incurred before the commencement of the business, the fixed assets cost, land building, leasehold plant, machinery, furniture, which are shown in the books of accounts. And if it's a case of extension of the business or setting up of a new unit, then again the cost of fixed assets which are there will be the cost of the project. So cost of project means fixed asset cost, including land and building. What is the meaning of the capital employed? So in case of the new company, for the new company, the capital employed means issued share capital plus debentures plus long-term borrowings as on the last day of the previous year in which business commenced. As on last date of previous year in which business commences. In case it is the extension of the business, in case it's an extension of the business or setting up of new unit, Then the cost of capital employed is again the same, but it is on the last day of the previous year in which the extension is completed or the unit commences production. Clear? So it's the same, but as on last day of previous year in which extension is completed or unit commences production. Clear? So you have to take into consideration the share capital, the debentures and long-term borrowing for that particular unit. Now your one doubt arises. There was the ruling where the question before the court was that in this case, whether the securities premium has to be considered or not. Whether do we need to consider the security premium or not in this particular case. So that was a question before one of the court. And what do you think? The Supreme Court in this case held that the share premium or the security premium is not the part of the capital employed. That the assessee is not entitled to include the security premium in the capital employed. So here in the capital employed, you can write down Berger Paints Supreme Court share premium not to be considered in capital employed. Are we clear? In the case of non-corporate, this was we saw for the corporate. In the case of non-corporate, what is the deduction? Limit of the deduction is 5% of the cost of project. There we do not have the capital employed. 5% of the cost of project. Clear? Any doubts? If the life of the asset is 8 years, so then it is transferred. Still we need to pay tax. Good question, Namita. But the law does not provide any exception for that. Okay, we'll stop here for today. You should revise, solve the sums. Now what is remaining is only two small sections, which is 35DD, 35DDA and 35E. So I can finish it off like in a minute also. We can again revise in the next class. 35DD is for expense for the amalgamation. 35DD is expenses on amalgamation, which is similar to the 35D only. Now, what is under 35DD? It is in the case of the amalgamation, these particular expenses which are incurred by the Indian company. This is available only to the Indian company. The amount of deduction will be 1/5 of expense over 5 years. Your deduction, right? And that is all. So the amalgamation, if it is an Indian company which has incurred the expenses wholly and exclusively for amalgamation. Are we clear? So that is allowed as deduction. Similarly, under 35DDA, we have for expense on VRS. Again, it's the same thing. It applies to every assessee who has incurred the expense in the form of payment to employee. Expense in the form of payment to employee in connection with VRS. In connection with VRS, then again it is 1/5 over 5 years. And this is also allowed in the case of the succession to the successor, or in the case of amalgamation, to the amalgamated company. Are we clear? Then last we have 35E, which is for prospecting and development of minerals, which is 1/10 of the expenditure which is allowed. So in case of 35E, it is 1/10 of the expenditure for prospecting and development of minerals. Both Indian company and non-corporate, 1/10 of expenditure. Clear? So I finished the PGBP. Aniket, if it's not given, I have covered it. Thank you, Aniket. Namita, if our expense is greater than 5% of the cost of project, there is a limitation. That's the limitation which is there. The other amount will lapse. Over and above 5% will lapse. Are we clear? Okay. The balanced out